Hey there, Wobbly Draft here again. We're going to continue a little bit further in the research we've done on silver miners. And we're going to watch one video, one of the reasons why I invested in silvercrest miners, silvercrest metals, excuse me, and why I like how they look at what they're doing. And it will provide a good basis for diving deeper into not only their financial data, but other miners. Okay. So I'm going to share my screen over here and we will talk about this. So this is the article I went over last video, and he talks about using the discounted cash flow modeling in a more proper sense to gauge silver miners or miners in general. I wanted to highlight one of the earlier sentences in the article that we discussed a little bit. He says that investors should not use PDE multiples, so the price to earnings multiples, the EBITDA multiples, the earnings before tax and something else, sure, or the price to book ratios, because those models fail to take into account the depleting nature of the mine. So I think that's a very important sentence there. And I think that's a good mindset. So what he's saying here is that it's very likely that a lot of these businesses are being valued incorrectly, one. Two, maybe financial algorithms of big banks, which handle a lot of money automatically, might be looking at those metrics instead of trying to understand the nature of that industry, right? Which means certain miners might be overvalued if they are using these ratios and those mines are depleting, and some might be undervalued, which is what we're looking for, if maybe they don't meet up to these ratios, but they do meet up to this better standard or what have you of accounting for the depleting nature of the mine. So once again, great article by Glenn C. I reviewed that in a previous video, so feel free to watch that. I do think the most important takeaway that he says very early on is we typically want to look at a discounted cash flow or DCF model as a way to, he says, model the economics of a mine. But when we do that for multiple mines, we probably can get a better picture of how that company should be valued in the stock market. Okay. So that's kind of the first part. And we're taking this into excuse me, my cat's running all over the place as normal. We're going to take this into this great video with Chris Ritchie. Let me move zoom over here. There we go. With Chris Ritchie, who's talking about why he thinks his company is better than a lot of the other miners out there. So I'm going to open this in YouTube just so I can make it full screen. Okay. And let me go over the facts. Let me give some shout outs. This is a video by Metals Investor Forum. It's a very good video, good host, and he gives Chris Ritchie the platform to speak about the company, right? So thanks to them for hosting this video. Peter Kraut, cool. Mr. President. Oh, can y'all hear the recording on this is the question. I didn't think about that. I'm gonna assume no, so I'll probably just kind of pause it here and there to say what they're talking about and explain the graphs. Probably should figure out a way to overlap the audio, but I'm kind of new to this still. Well, we'll play it by ear, I guess. So Peter asked Chris for that overview, the macroeconomic view of the mining sector. Great question. Okay, so Chris Ritchie pointed out this graph, and he says this is how commodities are looking to the overall market. So let's explain this real quick. The Goldman Sachs Commodity Index is an index that tracks most the commodities in the economy. And the S&P 500 is the top 500 stocks. So your mega cap corporations typically, and big cap in large cap in the stock market. Okay. Let's actually quickly just do kind of a side note, since I'm not sure if the audio from this video will be picked up. Goldman Sachs Commodity Index. So I'll be able to talk about this. Hopefully this sparks some ideas in other people, and it will be a filler in case the audio isn't picked up. My bad if it isn't. I didn't really expect that. So the Goldman Sachs Commodity Index is a composite index of English, it's so difficult, of commodity sector returns representing an unleveraged long-only investment in commodity futures that is broadly diversified across the spectrum of commodities. Okay, fair enough. Now let's look up the weights. I believe the commodity index is going to have gold, silver, stuff like oil, probably natural gas and other energies. So we do want to keep that in mind, that it's not necessarily hard metals, if I'm correct. The other thing with this index is it is on futures, meaning it's not necessarily holding any underlying companies. It's trying to hold the underlying commodities themselves, right? And futures is how we do that. I kind of looked at investing directly in this a while ago. There's some ETFs and mutual funds that follow this. I think generally, even in the long run, like the long term, it had a negative return, because one, they have to roll over the futures, which takes quite a bit of money kind of out of that index. So it's hard to follow it exactly. And you're going to be overweight a lot of things that you might not want to be invested in, right? So like oil, if oil takes up 30% of the index, right, and you were in it for gold, you could arguably still lose money even if you were just buying it for gold, right? So let's look up the components so we can learn a little bit about this. Oh, this doesn't look exactly like what I wanted. Say components. So it includes 24 commodity future contracts. Okay, interesting. I thought there was a place that it told me what it was invested in itself. Well, shoot. Okay, well, this is in 2007, but I would assume it hasn't changed much. So there's crude oil, Brent crude oil, heating oil, gas oil, so different types of oil, RBOB gasoline, natural gas, wheat, Kansas wheat, corn, soybeans, coffee, and sugar. So it looks like it even has, well, yeah, it has agriculture, which are commodities. I just realized that now. I didn't think about that. There you go. I learned something today. I could have sworn, this is frustrating, I would have liked to have been able to kind of talk a little bit more about what's in it. Second. Huh. Oh, let's just look what is in the S&P Goldman Sachs GSCI index. So I know it was, there we go. Let's look up this. This is, once again, let's go over why this is a good index real quick. It serves as a benchmark for commodity investments overall, right? So that's cool. Here we go. Bang. So we found it. So it can be valuable as an economic indicator, which is why a lot of analysts, such as the host of the show and Chris Ritchie, as a business leader, are talking about this. We can gauge the broad market, so that's good. and it represents most commodities. Okay. Now, one of the drawbacks comes down to these weights, and this is what I talk about. So, one, there's energy in it. Okay. So, crude oil, oil products, natural gas, fair enough. There's grains. Okay. Wheat coins, wheat, corn. I wish there was just straight up corn, and soybeans. Cool. There's also livestock, hogs and cattle. Didn't know that. That's kind of cool. I have no idea how that would work. Can you have contract? I guess you can have contracts on hogs and cattle. Good luck taking delivery of that. Do they just send bacon to your house? I don't I don't know. So soft agriculture, coffee, sugar, cocoa, and cotton. Okay, that's pretty cool. I know a lot of people trade that sort of stuff, so that's interesting. Industrial metals, aluminum, copper, zinc, nickel, and lead, and precious metals, gold, silver, and platinum. Okay. So now we have a more complete picture of what's in the index. Let's talk about these weights, because I do believe this is kind of the issue. Now, I'm going to assume this is the weights. I don't know what RPD, let's look that up. I would assume the W's for weights. Do a little research here, shall we? Reference percentage dollar weights. Okay, fair enough. Never heard that one before. I'm learning too. Anyhow, energy is 54%, so making up more than half. Okay. Grains is 15, livestock is 8, agriculture is at 4, industrial metals at 12, and precious metals, what we're interested in, only at 7. So that's one of the reasons why a lot of people kind of avoid investing directly in this, because you're more or less making a pretty big bet on energy, i.e. oil and gas. Grains is second, which I mean, that's probably done very well this year with inflation. Industrial metals probably also done very well this year because of inflation. I know that category has already pretty much taken off and will probably continue that category as well. Well, precious metals is at 7%. That's pretty low. So maybe something to consider in this circumstances, maybe that plays to our benefit as silver investors. If it's underweight in that index, and I'm sure a lot of people just passively still do, maybe some institutions hedge in this fund or this or in ETFs or funds that track this index. You know, a lot of that money's not necessarily going to precious metals. It's going to oil, gas, grains, and metals, mostly energy, oil and gas. Okay. So maybe that's one of the reasons why we see this underinvestment in precious metals, and we've seen them probably lagging a little bit. I know silver in particular behind the rest of these components in this index. Can't say I know a lot about hogs and cattle, whether they've gone up or not. Can't necessarily say this. I would guess they probably have gone up. I do know I've heard people complain about some of their grocery prices. So that's about as much as I could say in that. Either or, in general, to reiterate, it's a good broad index to kind of look at the overall macro level of the economy. Okay. Now he's saying commodities are very much underpriced, in the current period. They have picked up quite a little bit. They're still undervalued to the rest of the market. When was this? This was this year, only a couple months ago. But I can't get longer. You can't give me, I can't get like 20 years. What does he have? Oh, they only have, yeah, they have since the 1970s. Excuse me. Oh, here we go. This might be what I want to see. Bang. Hopefully that's the same graph. It looks like they probably applied the natural log, because it seems like, what's the spike? 08? Where's 08 in this? Oh, 08 looks lower than like the early 90s. Interesting. Yeah, I wonder if they applied some sort of log on a certain year to make it more level. I don't know. But we can see if we kind of do 25 years. Oh, well, I'm probably also in a different time period. What did they do? 70 or 70? Yeah, see if I do like 50. Yeah, see, I wonder if there's a way. Can I give it a custom? Probably. Oh, what's this? Let's do all and do. Let's play with see, none of those applies that long. Well, either way, we'll do 25 years. Still captures the same sort of sentiment. We can see the graph. Am I looking? I wonder if I have the wrong graph. Okay. I forgot something. Yeah. So they're comparing the Goldman Sachs commodity index versus the S&P 500. So I might have the right graph. It's just they're doing a ratio. Let's see if I can find that real quick. I did not think about that. Either way, I do want to say two things. Even without seeing the S&P 500 and this relative to each other, we can see this index is really starting to pick up since the end of a flat period and then a bull market, very short downturn in what, like that ended March of 2020, starting to pick up. Now the S&P 500, probably because of inflation more or less, has probably gone higher. Now I do know that people are starting to point out S&P and stock earnings in general after inflation have turned negative. That's the third, maybe fourth time that's happened in modern history in America, and the previous two did not spell good for the economy. I do know one was 2007, 2008. The other, I think, was in the 70s. So to see stock earnings per share or the dividends, it was one of those two, turn negative after inflation. Does not spell very good for the broad market. Yeah. Okay. So that was a very good metric I've seen people pointing about on Twitter. I might have covered that in a previous video. I'm not sure. I do know a lot of people have been posting that in Reddit sub forums for Wall Street bets and Wall Street silver as well. So definitely something to look into. I think quite a few big people tweeted that and were like, not a good historical trend when that happens. So let's see if we can find those versus each other. I would probably have to. Well, there's this. Now, this might have been what they found. The only issue is this doesn't go to 2021, but we can see that is the graph they're looking at, and they have it extended a little further. Oh, paywall. Oh, let's see what this is. Where are you now? Stocks to commodities. Well, what do they have? They have commodities to stocks. Yeah, the producer price index. Interesting. Yeah. I mean, inflation probably would kick that off. Where are you? Interesting. A lot of mining stocks in particular point out this ratio. So here we have it again, a little further out, 2017. I cannot seem to find it easily. I could calculate it myself, probably getting some of this data for free off of the S&P indexes because they're both S&P indexes. I do know we can compare them, but I'm not sure this is going to give us like a ratio. I can't get the S&P 500. Yeah. I don't want like the fits. Well, shoot. You can see here as a side note, iShares by BlackRock does have a ETF that follows that index, and that's what I'm talking about. So you could invest in that. You'd be overweight energy. Probably a better move for the average investor to invest in companies involved in that sector. So if you wanted energy for gas, natural gas companies, you can make more money one way or the other. I think this way is a little more dangerous than the companies. That's kind of a side note to what we're trying to look at. They say they have it here. Oh, that's not them compared. Let's see if Google gives. I don't generally like Google, but hey, each their own. Sometimes Google has better stuff. Let's see what this is. And see, and this is them forecasting it. So we're still not in getting up-to-date info here. And I mean, they're drawing what they predict. Granted, it is very low, so we do expect it to at least go up some. Let's see if we could chase that down, shall we? See, I wish I could have updated numbers. Well, oops, Rob might have something. You got the information from somewhere else. Yeah, see, my best bet would probably be comparing those two indexes. We'll just kind of fudge it for now. Do it visually. Let's look here. Yeah. Ooh, got a PDF. I love these long PDFs. If you at least give me number. Ooh, this actually might be a good PDF. Normally I'm against PDFs because they end up being research papers more than anything, but this could have some valuable insights. So I will save this for a later date. Okay. Can I get the S&P GSCI? Give me something. Come on here. No. All right. Well, either way, I can do them essentially side by side. So let's do the S&P Goldman Sachs index. Okay. So let's do 5-year here as well. 5-year here as well. So I see the only issue as well as if I wanted to do side by side, I have to do this janky thing where I have to do that instead of dragging it. Very frustrating. Anyhow, what would make this seeing if I full screen this, it's gonna throw whatever technology, right? You think I would be able to better handle this as a programmer, but I typically use Linux. So there you have it. Since this is the GSCI versus the S&P 500, you have a ratio, so you're dividing them, right? The GSCI would be over the S&P 500 here. So what would cause this number to increase, right? So either the GSCI goes up or the S&P goes down, right? Thus increasing that ratio, right? So if we compare these charts, and I'll probably try and get the raw data and just put it in Excel and derive those numbers. Either way, at the very least, we can see there's this total return down here, right? So the S&P had a bigger, well, let's do 3 years. Because I know we're trying to see how the ratio stands. I mean, hell, let's just do 1 year, right? We're trying to see how it stands as of 2021. Okay, yeah. So this tells a slightly different picture. We can see that the GSCI is starting to increase. Still probably has a very long way to go compared to the S&P 500, right? And what did I say? I said this this ratio that they're looking at to try and gauge how commodities are priced relative to the stock market. And if we assume, which I think is a very fair assumption at this point, most people would agree that the stock market is a bubble through very free money, low interest rates. It's that end of the economic cycle where people are chasing more risky assets for less and less return. I completely lost my train of thought there. Regardless, whatever. It's one of those days. I didn't sleep so well, but hey, that happens. Regardless, we're starting to see this ratio pick up because people are now starting to move into commodities because they see that there's very few real gains, post-inflation to be made in the stock market, right? And I think that's a very smart move. I think inflation's picking up. We have the free money from the Fed, low interest rates. Businesses are sitting on trillions of dollars that they're probably going to have to start spending soon to keep up their investment and attract new customers and clients, which probably is getting harder and harder to do. The bond market is pretty messed up. I know Michael Burry basically just put big shorts on the bond market to inverse, and that doesn't always spell recession, but when it does, it can be pretty bad, right? So there is that. There's a lot of warning signs going on. We talked about the S&P real earnings per share, or the dividends, I don't recall which, being negative post-inflation. People are talking about the Federal Reserve putting out kind of false numbers that inflation seems lower than what you would expect based on like past techniques of, hey, they printed 40% more dollars, like that's probably going to make inflation go up by 40. And the old inflation indicators are saying inflation's like plus 10% already, where the Fed, I think, is trying to say like, oh, it's only 4 or 5 or 6, which, mind you, that's already pretty bad. Ideally in my mind, it's a free market, or it'd be 0. The Fed is typically shot for like 2, 2.5, maybe 3, right? So we're seeing some distortions occur, very much so. Now, we did see that one article, I think I closed it, where that person made the prediction that this was going to go up at least to the median. I think they had the median between 3 or 4, maybe a little higher, probably around 4ish if I had to take a guess. And they had that dotted line, right? That forecast. And what I'm trying to point out here is we are starting to see this uptick quite a bit, but it's still probably very much below that median at the very least. And I mean, I expect it to go above the median, right? So here they're pointing out, yeah, it's super low. And that was only just like, what, a month ago? March, maybe 2 months? Yeah, 2 months ago. Well, we're starting to see that ratio is starting to go up. And that goes back to what I said, where how does that ratio increase? Well, we either see commodities go up or we see the stock market go down. I'll kind of add the caveat based on that. We see commodities go up more than we see the stock market go up, right? So that ratio is starting to increase, and it's probably not close to the median and not close to being that sort of bull run if we're trying to make plays based on this chart, right? So still a very good graph for gauging stocks and commodities relative to each other, okay? So what Chris Ritchie said here, don't know if the audio is kicking in. Sorry if it isn't. I'm going to try and upload it later somehow. You can more than welcome, please watch this video on YouTube. I think it's a pretty good watch for 26.5 minutes. He's talking about how they're positioning the company very carefully to survive an extended downturn. Well, I think that goes back to what I'm saying, where uh, the writing is very much on the wall that the economy is not on good grounds. Okay. Um, goes back to the earnings per share being negative post inflation, which has rarely occurred. And when it has, spells very bad things. I don't like to doom and gloom, by the way, but I'm just going with historical stuff, which might not be a predictor for a coming recession or what have you, but we have to kind of use past data to some extent. Regardless, Chris Ritchie's talking about how they're positioning the company for an extended downturn. To me, I think that's a smart play. I personally think we will see an extended downturn. Let me say right here as well, not a financial advisor. SEC, please don't shoot me. Leave me a nice letter. Just kidding. I'm not a financial advisor. I'm just talking about my personal investment decisions. I hope this can, at the very least, help people learn about the economy overall and stuff they should look out for as an educational exercise going forward. I think it's been really great to see a lot of people from every walk of life trying to learn about this stuff so they can make better investment decisions. People are getting interested in the stock market like never before, and hopefully they can profit off of this and use that money for good. So that's why I'm doing this. I'm not making any money or anything, and I'm just doing this for educational purposes. So SEC, don't shoot me. Thank you. Where was I? Tangents. I enjoy them. All right, they're set up for an extended downturn. Okay. So he also mentioned they're trying to position the company to take advantage of any bull runs in their sector. So silver, particularly. I mean, they have gold as well. They probably do some other smaller precious metals, um, or just metals in general. But gold and silver seem to be the main two. I like what he said there. I believe silvercrest, I could be wrong on this, is structured as a K1. I would assume most metal miners are, which is a different tax structure than most other stocks. Because of that, they have to pay out a certain percentage. I don't recall what it is off the top of my mind, per quarter to investors. And so what he didn't necessarily mention it there, but I understand what he's talking about, is Silvercrest can use a lot of the capital that they have to look for better silver mines, to explore for the gold and silver, and to mine it. And they can make a profit based on their current stock price for investors. Okay. And when a bull run occurs, they're going to be able to take full advantage of it. And what's nice about this is we can essentially buy this stock, hold it for the long term if we want to, take those dividends and invest them elsewhere, reinvest them, or put them in other parts of the market, right? So if there's a downturn in the S&P 500, we could take some of the profits from Silvercrest over time and put that into other sectors of the economy when they turn down, right? So we're buying them at their lows. I think that's a great situation to be in. It's a very defensive play, but it's a very smart defensive play. So that's great. Going back to what I said, let me check on Silvercrest metals. I believe I know most commodity related things are K1s. I know PSLV is a K1. What's odd is it seems very hard to find that sort of thing for a lot of companies. Oh, there's more news on it. I'll have to check that out. Sweet. Let's see, statistics, profiles. I don't know that that'd be under financials. Yeah. Here's their options chain. Interestingly enough, I don't think they have. Oh, they do have them for 2022. Nice. Okay. So because they issued some more options. That's cool. Where are you, my friend? I do want to look at insider trading for this stock as well, or insider institutional holdings, not insider trading. I know they said insider there. That's insider trading's bad. Don't do it. Where are you? I know Fidelity, my stockbroker, used to like easily say this stuff on the page of the stock, and I guess they moved it. So that's frustrating. Let's just search tax structure. Because if you were to invest in this company or the sector, right? Silver miners in general, typically you want to take note of this. So there is the 6K, which I believe that is a commodities fund tax form. Could be wrong on that. I have to look that up. Been a while since I've dealt directly with tax forms, to be honest with you. Not fun to deal with. It's a good reason for APIs and kind of these data brokers that a lot of people use. It makes this stuff a lot cleaner to deal with. Anyhow, I'm not seeing. Let's see what the form 6K is, shall we? Yeah. Let's just search it. I know, like, this used to be so much easier info to find, but hey, whatever. Let's see what we got in the prospectus while we're at it. Let's look up directly that tax form, because I know the companies that fill that out or fill out the K1 tax forms for their structure fill out different forms, I believe, than your regular corporation. I can't even think of what that term is. What is it? If K1 is a commodities index, what is? I need to sleep more. Regardless, we'll get there. Just a little harder when you're tired, but still doable. All right, so K1. Let's just look up K1 tax forms. That's going to directly give me that form, isn't it? Could talk a little bit about this, though. Either way, learn a little bit about taxes, right? So the K1 is, it's for partnerships versus corporations, which have more or less shareholders, right? And legally, certain companies such as PSLV, which hold silver, have to register as a K1 versus, say, a corporation, which isn't a bad thing. It's just the way that law works, one, to how the market works, because that better represents what they're trying to do. But K1 taxes can be very odd, because oftentimes you'll have like amended paperwork to add to your tax filing after you've submitted your tax filing. It can be pretty weird in that regard. How do I look up? Let's just find the tax structure of this company. Well, I'm pretty sure they're a K1. That won't be the focus of this video. I'll have to find that out later. It used to be a lot easier to find. All right. So right off the bat, I'm going to skip this section, but I do think Chris Rich is very good at pointing this out. It's just the Federal Reserve's printing trillions of dollars. Ridiculous amounts of money. I mean, even 2007, 2008, 2009, when people were like, why is the government giving trillions of dollars of bailouts to big businesses, banks, whatever? And that was 3.1 trillion. We can see this monstrosity is 3 times that. And that's, I mean, that's 2020. And we're still looking at 2021. I think we're already up to like 10, 15, 20 trillion. So it's like, and that's the M3, which I think I've talked about on this channel before as well. That's the money supply of the economy as a whole, right? So dollars, and the Federal Reserve in charge of essentially, well, actually, is it the Treasury? I know the Federal Reserve makes loans, sells treasuries and whatnot, and then I guess the Treasury prints the money. Very similar in that regard. We can see there's kind of a correlation here, and the M3, which is all that money in the economy, is going to the moon. Now, unfortunately, that going to the moon does not equate us going to the moon if we held dollars. In fact, it implies the opposite. I don't know what the opposite of going to the moon is. I guess digging a bigger hole in the earth and then hiding in it, but you get the gist, right? Now, I mean, this does mean there's upward pressure on silver and commodities in general, so we can go to the moon that way, right? And then on the right, he has the global central bank assets. So we see banks around the world, the central banks around the world doing essentially the same thing. And my research has found that to be very true. That's very worrying, okay? All right, I'm gonna go ahead and go to the next section. I do want to find this metric. So Chris Ritchie has a great point here about margin debt. He talks about it going very, very high. We can see that from the graph. And what that often means is businesses, and I'm not sure if this will include broader segments of the market. I mean, I know we're seeing higher foreclosure rates. Probably going to see credit card defaults go up and some others. So there is that sort of debt. This probably is just corporate debt, but it's also starting to go up. And what he's talking about is he says if there's a downturn, that spells disaster. And he's very correct on that. That businesses are taking a lot of debt on to chase diminishing returns. Okay. So is margin debt a bad thing? No, but there are certainly healthy levels of it versus unhealthy levels. And this graph to me is not showing one, what a healthy level is, but two, we're seeing that there is a much higher level of margin debt than the average, right? Now, how I would improve this personally is probably put this in real terms. So when I say real terms, that means accounting for inflation. I'm not, maybe it is, but we're seeing it has US dollars billions. So I would assume that's nominal over time. It's still a very bad level, even if we're looking at it from a nominal level. But if we did maybe a natural log just to smooth it out and get rid of the extreme distortions and just get like a level, actually, that might not be the best use here. But if we were just to divide this by some sort of inflation marker, I'm not sure M3 would be good here, maybe, but we would have the real term as either a percentage or based on some 0 year. that would give us a more reliable picture. Because, right, and let me explain this real quick. Here, we'll say this is, it looks like it's 300 billion, right? Well, $300 billion in December of 2000, what does that equal in billions of dollars in 2008, right? If inflation was enough in this period, right, this could essentially be the same amount as this. But this part of the graph shows us and gives us the idea that margin debt is worse here. Well, if inflation was 100%, then like, this margin debt's probably better, right? So that's why I'm talking about there. But this is still a good graph because we're seeing it fall off. Well, not fall off a cliff, I guess go up a cliff here, right? So if we kind of made some sort of trend line to account for this, where these are considered extreme, and I mean, let's build on that, right? This is 2000. Well, we had the 2001 tech bubble, right? Well, that's here. 2008, 2007 financial crisis. We went from the peak, right? 2006-ish, maybe that is. Great recession, right? So we do see it fall. Well, if we kind of take those as a trend line, I'm going to assume this is COVID-ish, maybe not. I kind of want to include that, maybe not. I do know we had a broad stock market sell-off in about 2016, 17. I was around for that. The stock market bled, what, 15-20% maybe. Economy overall seemed to be doing fine, but there's that. There was more uncertainty for sure. The VIX took off. Regardless, we can, I'm going to assume this is COVID. I could be wrong. We can see that the growth here is much more pronounced than in these other cases. So not even getting the real metric here, i.e. adjusting for inflation, which would probably be a better graph. This is very worrying. Okay. So yeah, still a good graph. Don't get me wrong. Sure. So he talked a little bit about the sentiment change, right? So when we get to this stage of the economic cycle, right, where things look like they're growing, i.e. in this case, the S&P 500, where stocks are going up every day, that doesn't necessarily spell well for the economy. Once again, that happened 2001, 2000, that happened 2007, 2008. Well, once that sentiment changed, like Chris Ritchie talked about, it very much causes a big downturn, right? Because everyone's trying to take the gains, and then boop, and then it causes a crash and causes a lot of issues for pretty much everyone involved. Okay, so. Uh, he's got a good sense of humor. Hopefully you heard that. I'll go over this. Here's another great graph. He's talking about the year-over-year change of the money supply, which in previous slides we saw was the M3. Here's the M1, which is similar. It excludes certain stuff. So I think most people think the M3 is probably a more reliable indicator here. But for all intents and purposes, it's telling us the same thing here, that the money supply or the amount of dollars in the economy has gone ridiculously high. Velocity is another important factor. I need to find that formula. I had thought I talked about it in a previous video. I don't think I published that one, but a formula for inflation, just breaking things down super simply, is the amount of money we have, or the money supply, times its velocity. So the speed of money. And no, I don't mean putting money in a cannon and shooting it somewhere. That doesn't increase the velocity of money. I mean, it does that money, but not the money of the economy. It's how quick people are spending, right? So if I had $10 trillion, but I wasn't spending it at all, well, there wouldn't be any inflation from that $10 trillion that I have. Now, if I have $10 trillion and I'm spending it, someone else gets that 10 trillion, spends it, very quickly, someone else spends that 10 trillion very quickly, et cetera, you now have a very high velocity of money, and that will make inflation very, very high, right? I mean, ideally, we would want um, people to have money based on their skills, how much they're contributing to society, right, in a fair and free market. Okay. And the velocity would be not ridiculously high or say low. People are spending money on stuff they need. There's not this irrational exuberance that some economists have talked about, right? Easy money, if someone's getting paid $1 billion, or like a bank's getting a $1 billion bailout, and then they go spend that and they're like, oh, we're not worried about the risk. And someone else gets that, spends $1 billion, and we're not worried about the risk, and so on. That's going to increase the velocity in a very bad way, right? Now, velocity isn't just banks, it's everything in the economy. So you, me, the SEC, please don't send me to jail. Businesses, small businesses, medium, big, I mean, banks, you name it, right? So that's important. So money supply is important, the velocity is important, okay? I will try to find that formula. Actually, let's look that up. Was it Irving Fisher? Now it is, I mean, it's slightly dated. I know people always come along, make a more complex formula that more accurately describes the situation, but conceptually, I think it's pretty good. Was this it? Was not it. So money supply times velocity. There's the other side of the equation that we wanted to look at. Here we go. So it's mv times pt. Okay, so v is for velocity, fair enough. P is for average prices, i.e., I mean, inflation, how much we're paying for stuff, right? T, what is T? T is the total volume of transactions. I think some people have, so some people have replaced that with GDP. GDP being a dollar amount of all the goods and services in our economy. So if I went out and I bought a bunch of stuff at the grocery store, in my world, my part of the economy, that's essentially my GDP. But the GDP was the whole country, right? You could do this by county, by state, by country. I mean, people do international. What's the international GDP? We do want to think of this both in the macro and microeconomic sense. Okay, so macro would be country, international, maybe state, sure. Micro would be how it affects us. I mean, me. I gotta say that me for the SEC. Don't arrest me, not a financial advisor, but it affects the average person, right? So we have the amount of money in the economy. Let's just go with the country because we have a central banking system. We have how fast it's being spent. That equals the price level times essentially the total amount of goods in our economy, right? So what we're interested in here is, well, we think GDP is at the end of an economic cycle. It probably will stay flat or will decrease, right? Well, what's that going to do to P, considering that money's going very, very high, right? Or M's going the amount of money, M is going very, very high. Well, even if velocity stayed the same, if M's going super high and T's going down or flat, V's gonna, well, I think I said we assume V's going sideways, P's going up, right? So it's a very simple equation, excuse me. I think it's very insightful. A lot of people still refer to this. There's way more complex formulas, I'm sure. But conceptually it makes sense, and people have found it does realistically model these sorts of situations. So we know M is up. Richie here is talking about, well, like we're pretty sure velocity is going to pick up, right? Makes sense to me. If M and V both go up. Well, and we kind of assume GDP's run its course for this cycle, which I think is fair enough. He's going to go up quite a bit, right? Which means inflation's going up, the price level. Okay. So I think that's another argument for commodities. Okay. Very good graph as well. What's weird here is the CPI, the Consumer Price Index. The Federal Reserve more or less changed how they calculated it. So they left out a bunch of things. They might have even renamed it and just be using another indicator. There are people out there that are publishing research saying that inflation really already is 10+%, right? So the P is already increasing. I can't necessarily attest to that, but I know I talk to people every day. They're like, yeah, gas is going up. My medical bills are going up. My insurance is going up. My grocery bill is going up. That's inflation, right? Interestingly enough, this doesn't include 2021 yet, but we can see that inflation all along here is relatively low, 70s, huge. I think we have 15%. We topped out at what, like 14? But if you had even like 5+% year over year, that's not good. And I mean, we see here, it looks like it's +10 for a couple of years. So last highly inflationary period, sure. I mean, we're looking at a very highly inflationary period coming up. Okay. So once again, I don't know if you can hear the audio. I'll try and figure that out. Probably the last time I'll say this. Don't necessarily want to make a boring video where it's just watching me watch silence, I guess. So I do try to provide commentary. I think Chris Ritchie said some very smart things there as well. And he basically, past couple slides, looked at the case for inflation going forward and the economy slowing down. Okay. So right off the bat, I agree with his analysis. I haven't seen this from the other miners. And I think to me, that says that the silvercrest team in general, because I've seen some videos by the rest of them, seen some posts, I think they have a better mindset for the economy, right? And we could have the best business in the world, but if we don't have a mind for what's going to happen in the near or far future for the economy, that could spell disaster for our company. So, I like this video very much overall, and I think Chris Ritchie, having done this research or talked with other people who have in the Silvercrest team, I think they have a very good mind for navigating the current economic climate. And since they do mining, they're going to boom from what I consider, plenty of research from other people, not me, I guess, but what a lot of people consider will be a bull market in silver. So, yeah. Okay, so I'm gonna stop it right there. Hopefully you can hear that. Definitely watch this part of the video, if nothing else. I think Chris Ritchie pointed out some great stuff here. Okay, so he pointed out the yield on the Huey, the gold index, is higher than the Dow, right? So already we're seeing gold and I would assume silver and commodities being a better play um, than the stock market, right? And that goes back to some of the previous slides as well. He hasn't gone into this part yet, so I'll let him talk about it, and then we'll talk about this. But he does talk about how essentially miners for the past 25 years. Now, this was by Crestcat Capital LLC. I did find that resource. I'll either review that or go over that, or at the very least link to that. They have some good resources to read and learn about the economy as well. So that's cool. I do like that we have third-party information for all of these sites as well. Very verifiable. Regardless, the point of this graph is saying that for the past 25 years, a lot of miners have been capital destroyers. Now, you could argue part of this is the price of commodities was very manipulated, which is true. But I think that also points out a lot of what our friend in this article, Mr. Glenn, pointed out, that a lot of miners are engaging in legally cooking the books, painting a better picture of their minds or their costs or what have you. Okay. And when we see this term, they're a capital destroyer, that means that at the end of the day, their business probably went out of business and along the way lost a lot of capital or money for its investors and the economy as a whole, right? Ideally, we want good companies that are making uh, profits, that are making returns for their investors, okay? Also treating their workers right, hopefully taking care of the environment or what have you, doing what they can there, but they're engaged in good business and good business practices. And one one way we can at least measure the money side of this, right? Because there is that ESG, the environment, social governance impact, which is another part, sure. But one way to measure at least that monetary side of that is, are they capital destroyer or producer? Well, if they're destroying capital, they're essentially taking money out of the economy, running a bad business, going out of business or something similar, maybe merging with someone else and then just kind of hiding it, like Glenn talked about. And the net result is negative for everyone involved, right? Investors and the economy, because that's money that's just essentially being taken out. We could think of it as being burned, but I guess wasted is a better way of putting that. And there's no return. So this is a very interesting graph, and this is, I think, very key for my analysis. Okay. And I think that brings up a couple interesting points. I might reiterate the points here because I know Chris is going to say this, and I just want to say it first, and then he'll say it, and I'll build on what he's saying. But he's pointing out about talking about the median trailing. Okay, so the middle, the past, the 12 months, so the past 12 months averaged out, okay, free cash flow, so FCF, to enterprise value. So this, the free cash flow, the trailing cash flow for 12 months, but the free cash flow over the enterprise value, the EF. And that's a formula, and I'll probably look at some others, evaluate them, see how they compare. But that's a formula that Chris Ritchie is looking at probably for his own company and the sector as a whole. And that's what Crescat Capital, right? So independent third party capital fund of some sort, maybe they're a hedge fund, I don't know. But it also says it's on Bloomberg. So, I mean, I would assume they did the research and published on Bloomberg, sure. But they calculated this, and what we saw is that a lot of these precious metal miners, and this probably includes silver, and it's probably all miners, I would assume, but they destroyed a lot of, or wasted a lot of resources over the years, except maybe a little bit. And what is that, 2010? And then going forward, it looks like they'll be positive. Now, there's two ways this can occur, right? So silver can go so high that, right, the manipulation stops, silver goes super high, those companies are making more money. Sure, that's one way. The other way, which I think is just as important, is better business practices, or just better business methodologies, like running the business better, right? So Chris Ritchie, it sounds like for the past couple of years that they've been running, they've been keeping an eye on this and trying to improve the efficiency of the business itself. Okay. So even if silver stayed at this current price, right now, it's, I mean, it's almost going on, actually went down a little bit today, but it was heading up to 30. About $28. So if we assume that that was the ceiling of silver, it wasn't going any higher, which I think is unrealistic and not true personally, right? Not a financial advisor. But if we assume that, right, we still would want miners, and this could be applied to any industry, well, we would still want miners to be improving their underlying business practices. So the very fact that Chris Ritchie talks about this to me is a very positive sign in his company, or yeah, his company, Silvercrest Metals, right, and their team. I very much like their team, their background, their number of years in the industry, their experience, their credentials, and all that stuff. Okay, so all around, very much love the company. I like the stock, stonk, I guess, as people say nowadays. Um, so I think that's a very important graph. And that also, and this is the kicker, to me, looking at some of these other articles on how to evaluate mining companies in our context, primarily silvercrest metals, they talk about ways of modeling the economics of the company as well as the financials, right? Well, let's come back to the article I found that was the most digestible and presented the same sort of view by Glenn. Well, what does he talk about, right? So he talks about using that discounted cash flow. Okay, so maybe we'll compare that in the free cash flow. But we're at least looking at cash flow. Okay. Uh, Chris Ritchie in this case is not looking at that PDE multiple, which is what a lot of people look at for other stocks. We're not seeing the EBITDA multiples, and we're not seeing the price to book ratio. Okay. So not only does that further increase my confidence in the company as a good company, it gives me a guidepost to compare across companies. So I'm going to be looking at the mine lives and that discounted cash flow. Okay. And we'll be comparing this metric, the median trailing 12-month free cash flow to enterprise value. Okay. Now, along the way will be examining other ways of doing this, right? Are there better models? We'll see. Maybe, right? That's the good thing about this, is it's a great starting point to spitball and look at some other metrics. But I do think it's a great starting point. Okay. So yeah, that's awesome. So what he's talking about is what he believes is the issue with some of these other mining companies is they probably have been in this group of capital destroyers. So they're not positioned to take advantage of the coming bull run in silver, or just if the prices stayed the same, right? And what happens in a lot of those cases that he talked about is dilution of shares. So selling more shares to raise more money, but they've just been kind of losing money. So it's not necessarily a good investment. Or M&A, as he puts it, mergers and acquisitions. And we see this quite often with mines. And once again, that's something that our friend Glenn talks about in his article. So what happens, right? We see the mergers, right? Now he's talking about merger synergies not existing, but we do see these mergers, right? And he's saying, yeah, companies might merge and spin this as like, oh yeah, it's great. And like, nope, it's probably not, right? He's also talking about how please watch this video. It's a great video. It's well worth 26 minutes of your time if the audio isn't playing here. Sorry if it isn't. Um, what's crazy is I feel like it throws my brain for looking at other businesses, right? In the economy as a whole. It's a great analysis. Anyhow, something we talked about is the bigger companies, probably in part because they were capital destroyers, they haven't necessarily made like a real profit, in quotes. They are unable to engage in exploration because it's more risky. Okay. And because of that, they have to buy mines that have already been explored. Maybe the best days of that mine are behind them, and they then have to take that more less risk but less reward sort of stance. So that kind of keeps them in that capital destroyer phase unless somehow they can raise a bunch of money. I guess like silver going super high would help them out a little, but that's not changing their underlying business practices, which aren't good. So yeah, a lot of the big players in the field probably are worse off than they might appear to be. And that's something we will research. Okay. I think Chris Ritchie is giving a very good perspective on this. We're not going to just take his word for it. Okay. Um, Not that we have a reason to distrust him. I mean, he seems honest, he seems earnest, he seems like a good leader of the company. But yeah, we want to carry out our own due diligence as well. Okay. So exploration is more risky. So he's now pointing out the benefits of his business, that they are exploration. So they're going for that higher risk, higher reward, but they've improved their underlying business practices. So they're better financed. They've improved their efficiency in terms of mining and exploring. That way they are capital producers. Fantastic. Okay. We will check that. Right. And he says we're one of the few companies that has made it through. Maybe the other companies, they might appear good on paper unless we do some deep digging, but in actuality, they're not in a good situation. That's very, very possible. Okay. Okay. Chris, we're just going to talk about this chart. I can't say I like this chart. It's kind of set up weird. Not sure I would put bubbles versus like a second bar chart, I guess. But we see the US average price to earnings ratio since 1920 by different inflation buckets. This actually goes back to what some economists have researched, that 1 to 2%. I mean, once again, I generally disagree with. Ideally, we would want zero, but whatever, teach their own. That the highest P/E ratios, which could be taken as a gauge for how healthy the stock market is doing, what have you, appear best around that 2%. Okay. I'm seeing the other blue dot, which confuses me a little bit. It's the number of observations. I don't know what RHS is. So I'm just kind of taking, and this is what he talks about, the average of the blue bars. Well, like inflation, according to some, is already 10%. The Fed printed 40% at the very least, and rising more dollars. Well, inflation is going to be outside of this chart. And what do we see here? A downward trend. Okay, in that P/E ratio. So like stocks are not going to be doing so good overall, except for defensive stocks, right? So 100 years of data, respectable. So he's talking about this one as well. 21 plus PE multiple. Markets are at all-time highs. PE multiples are at all-time highs. Inflations are technically at lows, hidden, but it's picking up. That's what he's talking about. I don't know when things change. Well, hey, they're starting to change. Nope, he's saying totally wrong. He's totally right. Inflation's starting to go higher. Multiples are going low. Saying this is the cheap sector. This is the deep value. I prefer the micro fucking growth. Oh, I cussed. That's my Reddit username. We're on YouTube. I didn't mean to cuss, but it's the micro fucking growth sector. So he's saying it's a deep value, which I mean it is, but yeah. So he's saying we set up Silvercrest, or him, them, I guess, we set up Silvercrest as navigating a prolonged downturn, which he presents the some of the data. I've seen some of the other data from other people, happy Hawaiian people on Twitter. I mentioned some of that. Very much so, we're looking at a prolonged downturn. Okay, so he's got that mindset and still return value to shareholders, right? So very much happy and appreciative of that insight. I think that's great stuff. Okay. So he talks about the corporate structure, and how they've been financing themselves. I'm not going to spend too much on this at this point, but something he points out, and we talked about this a little bit more in the video, was a lot of the other miners engage in dilution. So they essentially are losing money for shareholders. And then at some point, they're either issuing more shares or merging with another company. And that's not necessarily the best way of raising capital. And that's one of the reasons they're capital destroyers, right? And he says they're very, very careful to not do that and get financing in such a way as to increase shareholder value, right? So I'm going to kind of gloss over this. I might come back to this another time, but very good. No complaints. Just skip along here. Okay. This is another graph that's very good. He talks about the dilution management and capital efficiency. The feasibility studies for this company are 3 times faster than their peers. I think they have 2, maybe just 1 on new properties, right? So they want to try to get mining as quickly as possible. Before they start mining, they engage in feasibility studies. So if the feasibility takes less time, mining also is going to start quicker, okay? They have a strategy to continue being funded through potential cash flows. So increases in revenue, profits, etc., i.e. silver is going up. It is, there you go, check mark, not engaging in dilution. Okay. And not concerned with that third point, but hey, that's a good one. And something they talked about here is, so let's go to the chart itself, that their company compared to other miners in the industry spend about 7 years, okay, from the beginning of, I guess, the mine or acquiring the property or whatever to actually mining it. So we're seeing that their time to start getting that silver and start engaging in making profits is less than their peers. So we see 19 years for historic development peers, okay, now in production average, and 22 for development peer average. I mean, what's 22 divided by 7? 3 plus 1, right? So 3. They're 3 times quicker, and that's what that is, right? That's great. And what that means is they're also set up to take advantage of any silver bull runs more than other silver mines. If we find some of the other silver miners are at the end of their mine life and maybe they've started the feasibility study and we'll look at the dates, and maybe the date to complete that feasibility study is way down the road, they're out of luck. They're going to miss the bull run, right? And Silvercrest has, I want to say 1, it could be 2, but they're also engaging in great expansions of current mines. They will have the ability to take advantage of that full English today. They have, I need to sleep better, people. I need to sleep better. I didn't sleep well last night. Anyhow, they're better positioned to take advantage of a silver bull run. Okay, so that's a great chart to kind of make that inference off of. Okay. So he's talking about appealing to, excuse me, he's talking about appealing to bigger funds, whether it's mutual funds, ETFs, or just hedge funds or just investment funds, right? They are still a micro cap. He talks about having high volume, so that's good. Um, Actually, they're slightly outside of the micro. I think they're still in the micro cap size of the company. But he is talking about trying to appeal to those bigger funds as a good investment vehicle. So as a good hedge against inflation, or at the very least, make good returns, even in, say, not necessarily a silver bull run. Well, I mean, I think that's going to happen, but I think that's a good perspective to have, that they want to make money even if silver prices went down a lot, which I don't think that's going to happen. But that really pushes the drive to innovate. Okay. Now, as far as the funds go, okay, we could see the stock price of this company increase a lot if they can grow enough, and like he says, appeal to these big enough funds, right? So they have to be very profitable for that, which they appear to be. They're in good financial standing. Um, uh, yeah. Um, but they want to appeal to these larger funds. Well, that also means that there's going to be a lot of profit to be made there when these large funds pick up on that, right? So let's say the silver shortage continues to pick up in intensity. Okay. I think that's a very fair assumption. A lot of people on Reddit will agree with that. And I mean, across the world, what have you. That then means the silver miners will be turned to mine, right? Get more silver, drive that price down. It's high, it's super profitable. Well, their company's better situation to take advantage of that from what he's claiming, which we will check. Um, uh, but that then also means that their stock, more likely relative to other miners, will be picked up by big funds, right? Institutional investors. Okay. And what that means is that if we get that early entrance into the stock before more of them, because I would assume there are some institutional holdings, but before other institutions really pick up on the stock, well, that means that we're gonna make more money. Bang. Cha-ching. Heyo. So I like hearing that. I find this hilarious because this is the only sentence in the video that stands against what I have to say. But hey, fuck it. Um, I'm trying not to cuss. I just keep doing it. Whatever. Um, I'll work on it. But he talks about wanting his company to be seen as a hedge and essentially a value company. They're building value for shareholders at a consistent rate, probably paying out some dividends. Um, and so they're making money, but they are a hedge against essentially inflation and probably somewhat of an economic downturn. They can still make money on silver enough to be profitable, okay, compared to other miners. Sure enough, he says they're not looking to be that growth story. Well, he also says in another video, actually, well, it might be later in this video, so I'll bring up that joke later. But I think in the short term, I do see this company's stock price taking off very much so. I do think in the long run, they are more of a value company, right? So I agree with it, what he's saying. I do see this as a growth opportunity. But I'm not going to disagree with what he's saying because he's right. But if silver takes off, they're going with it. So like, that's growth to me, baby. So they build their minds quickly. They build mines quicker. They start mining quicker. More profit. 7 years from first drill hole to cash flow versus 22 and 19, mainly 22, but 3 times as fast, 3 times plus. He's talking about having their processing facility. That's also something to look at for these miners. Probably some throughput involved in that. Sure. $95 million reserve ounces. Now, this does include gold, since they're doing gold and silver converted to silver equivalent. I mean, people are saying gold's going super high as well. Yeah, that very much tracks inflation. 95 million ounces of silver equivalent. Now, I know some other miners might have bigger mines, but it's like, are they toward the end of that mine life, right? So it's like, well, it's like, oh, we mined 50 million ounces of silver this year. Well, the next year they have zero. Well, I mean, if these people mine 95 over, say, 5-10 years, just kind of an example. It's like, who does better, the 50 or the 90? The 90, right? Just as a frame of reference, I guess. Top two or three highest grade silver mines in the world. So they have very high grade mines. So something he said here, and I absolutely take his word for it. I mean, it makes sense to me. This is kind of what I found in my research. And there's not really a tell on this, but they have 15 out of 45 known veins in the reserve estimate, right? So I think that's another reason institutional investors have overlooked this company, right? But this company has a lot of silver that's not in their accounting books yet. Now, that's super legal, right? They still have to explore for it, right? It's not them lying about it or anything. So it's they're pretty sure they're there. They know they're there, but they have to still figure out how much silver is in it or similar. Maybe some of them, they already know some of the silver that's in it, but they have to do further studies and they have to mine it, right? So I misspoke, I guess. Need more sleep. Regardless, what he's saying is essentially only 15 out of 45 known veins are currently like in their accounting books. Well, it goes back to the thesis I had at the beginning of the video, where a lot of these big algorithms run by big banks and whatever wouldn't pick this up because it's not on their accounting books yet. Okay. So if they look good accounting wise, hopefully they look better than the other miners, right? And I think they probably will. If they only have 15 of 45 veins, which I believe is just one of their mines, not even all of them, on their books, it's like, uh-oh. Uh-oh. In a good way. So that's in the reserve estimate, right? And that this is from 2 months ago, so maybe it's picked up a little bit, sure, but I would assume not all 45 are there yet. Okay. Oh, and once again, I kind of misspoke. I was like, oh, it's not them cooking the books or anything. That was misspoke. They're not doing anything illegal or unethical or sketchy by doing that. It's the nature of them as an exploration company. Okay. Now that does make them a riskier bet, very much so, because maybe those vines aren't necessarily full of silver. But considering most of the veins they've gone through have had some of the highest grade silver in the world, even if we assume the rest of the veins were about average, that makes this company a outperformer because of their lower costs of getting that silver and refining it and their other business improvements. Okay, that's great. It's great. So the CEO built the mine next door and they sold that on time under budget. And he's also pointing out a lot of their capital expenditures are flat. So they paid someone else to essentially, what did he say? Not explore the mine, to build the factory. I completely misheard, but basically they had a contract. And if it goes over budget, other people pay for that. Okay. That's a good business negotiation. If that was not the case for some of our other miners, their capital expenditures are very much variable. Okay. And with the economy making a downturn or whatever, right? There might be, especially with them as a capital destroyer, there's less reason to give them more loans or more funds. Okay, so variable capital expenditure and like decreasing availability to get loans if there is a prolonged downturn, like, and this company has it as fixed and is well financed. This is it, baby. There's cost overrun, they pay for it. So a lot of their capital expenditures are very fixed, 80%. And then 20 is for COVID. Not a lot of variability, like you said. Very true. $140 million. Where do you say that? Initial capital. Okay. Life of mine sustaining capital. Half of that's fixed, like you said. So they're better finance, right? They're being very conservative with their financing. Very smart move, especially with how things are looking for the future. Where did you say that? So cost profile, what do you talk about? The mine life, 8.5 years. I know our friend Glenn said that seems to be a good number. Don't look at mines longer than 20 years. That's not 20 years, so we're good there. We have our mine of life profile. I think this is good to look at. This is some of what Glenn talked about in terms of just giving us very transparent numbers. Sure. We can see that their silver production is going to pick up. I think they have, well, oh, so process, my bad. So they're mining. They're going to mine a lot more this year, start processing it. Okay, so they have stockpiled quite a bit. So I would assume some of this, since it's not processed, and that difference is there. Okay, you can see they're really starting to, yeah, that's not their stockpile balance. Okay, sorry, yeah, two grays, but processing a bunch of silver, mining a bunch, mining a bunch, mining. So we can see mining is ramping up, staying pretty constant, and then going down 2029, 2030. Fair enough, okay? And they're processing more, they're ramping up production, keeping that relatively flat, and that's going down with the mining. Now they have other mines as well that they might have to build more processing plants, but they could cart some of this in. I know Las Chipas and one other mine, I forget the name of it, maybe it was Picacho, Pichacho, I don't know if I'm saying that right, is in distance. They could truck it over, so you would see less spending on the processing plant. Okay, so maybe this could be extended somewhat to include that mine. Now, this is for one mine, the life of the mine, so that's not going to happen in this graph, but that's a possibility. Okay, um, what I kind of take out of this is it seems like they're being very careful in that they're trying to ramp up their mining while they get their processing ready. They're going to process, they're going to stockpile and process that silver and just very kind of keep it steady. Obviously, it's going to come down as the mine expires, but by this time, I mean, by the latest 2027, 2028, maybe 2029, they already have another mine they're building out. Maybe they'll get some more, right? They're definitely doing prospecting. They're exploring other places. So this, to me, for this one mine alone, paints a very good picture of the company for me. So mine life, 8.5 years. The throughput of their processing plant, I would definitely want to compare that to other um, miners. That being said, what if another miner has more processing, but like they're at the end of the mine life? That doesn't spell a good thing, right? They probably paid more for that processing plant, which might have served its purpose early on, but now it's just an extra plant, right? So average annual gold produced 69.0 kilometers, kilo ounces. Average annual silver produced 6.4 million ounces for just one for just one mine. So real quick, 6.4, so 6.4 million. I believe that number is correct. 3 zeros. Let's just say silver went up to 100, right? Which that's, to me, that's very conservative. Okay. Uh, I think a lot of people have agreed with me, including Happy. I didn't ask him, but Happy Hawaiian, I think his projections were like, what were they? I mean, 200, 300. I think they might have been 500. I don't recall. But yeah, so what do we have here? We have $640 million for per year just for that one mine in this company's portfolio. Okay, 640 million. Now, what you would have to take out, right, is what were their costs to set up the mine, the factory, how much it is to mine per silver ounce. Okay, and that's not even including gold, right? And gold's gonna go up too, and gold's already of like $1,800, right? So like that's already gonna make some cheddar right there. But if their price to mine is essentially 6.68 per ounce, well, okay, let's kind of just do a super rough number. Now, this isn't including any of the capital expenditures and whatnot. It's just a very rough number. But we said we had 640 million. 1, 2, 3, 1, 2, 3, minus, and what did we say it was? And once again, their cost of mine is improving and their efficiency is improving, which improves both of those numbers. Or what's that? I'm gonna close this. 6.68. 6.68. And this doesn't include the gold. What was it? It was I need a calculator. I somehow uninstalled Windows calculator. I don't know, very stupid. 6.4 million, right? 6.1, 2, 1, 2, 3. Right, so like their raw revenue, what have you. Well, they would still have to process stuff, other stuff, process it and other stuff. So I guess it's not necessarily a final number, but it's like even just subtracting their cost per month, right? We have almost $600 million, right? And what's crazy is, what is Silvercrest Metals stock price? Let's look that up real quick. It's still sub 10. Okay. It is still sub 10. Okay. So for like less than $10, you're getting a stake essentially in that 6.4 million ounces just for that mine. And there's other mines. So you're getting a stake in that. I have to say because the SEC will come after me. A investor making their own decisions, not a financial advisor, SEC. Right? So if you were to do your own research and due diligence and decide to buy a share in this company, right? For less than $10 currently as of today, I mean, it's going up, you would have a stake in this one case, which is not the whole company, in 600 uh, oh, what did I assume gold was going to in that example? Gosh, let's do that real quick. Let's just do it at the current price. Why don't we? Right. So 6.4 million, 6.111111 times current price is what? We'll just round it up a little bit. Oh my God, since it's 28, and then do their minus the cost of mining per ounce, which we said was 6.68 or 6.88. Where are you? It's 6.68. So even at today's current prices, okay. Now, obviously, this is their future mining, right? So, like, we're holding a lot of things constant here. But even at today's prices, that's 136 million, okay, per year, I believe, for what, like the next 10 years. Well, let's just, yeah, so average AG. So yeah, I would assume they took some from these to average across, right? So we're looking at the average silver production. Okay. We're looking at roughly at today's current silver prices for the next 10 years, we're looking at 136 million, right? So let's just do times 10. I mean, it's already 2021. We'll just be conservative. Why did that? Oh, I forgot my stupid parentheses. So we'll just do 9 years since we're being conservative ourselves. You're looking at, what is that? 1.2 billion, right? Well, what's their market cap? 1.4 billion. Okay. So we're kind of leaving a lot of stuff constant. We're not taking out a lot of the other costs and whatnot. But just from this one mine, and they're searching for other mines, it doesn't include all the veins. They're trying to constantly improve their cost and their efficiency, which they've been very good at. You're looking at this one mine coming close in its raw revenue to their market cap. Right? So, I mean, Chris Ritchie says it's the deep value, but it's like it's gonna be deep value after it's mega fucking growth. I need to stop cussing. I get tired. I cuss, man. Whatever. Screw it. But yeah. So, and how many shares do they have? He talked about their volume. The volume, it's a little above. Oh, okay, so that was volume for the last trading day, so it's close to 1 million. Yeah, so it's not bad. Ideally, we would want it higher, but it is a smaller company so far. Okay, so we'll see how that goes. You can see their beta to the stock market is 0.5, so it's not perfectly correlated to the stock market, i.e., it's a good hedge. Okay. What else do we have? It's a bumpy ride, that's for sure. What else do we have? $100 stock price once they start producing, and we have $50 silver. I mean, I think 50 is conservative, but yeah, I agree with that sentiment. You can see, right, some of these comments, low PE, not a good metric. in my opinion. Not to bash on this person, but that's what everyone looks for in a company. That's not what we're interested in for this company. What else do we have? You can see a lot of these accountings, right? And this is Yahoo, but a lot of the algorithms look at trailing PDE, PDE, price to sales, price to book. We do see enterprise value here to revenue. Maybe that's not the worst. Enterprise value to EBITDA. Probably not what we want either. All right. So a lot of these are not filled in. Flow percent held by insiders. So I would assume people in the company almost 3.5% held by institutions. 50%. Wow, I didn't know it was that high. They have shares short. Not a good move. 2.9 million. Short ratio 3.6%. Not a good move. Short percentage of shares outstanding 2%. Shares short 2.95. Yeah, I do wish we had more numbers here. I'm gonna have to do a lot of digging myself. That's okay. Nothing else I'm too interested in at this point. Okay. Regardless, I do think the company in the short to medium term is a growth company, a very good growth company. In that kind of medium to long term, they are a deep value company. So that's why I'm fully invested in this company. So he's saying that free cash flow is what he thinks differentiates them from other miners. Well, we know Glenn talked about looking at the discounted cash flows. Okay. So there is overlap there. They seem to have a similar opinion on how to value their companies. One is a outsider and is not involved in the company. Glenn, he is the person running the company. They seem to have similar ideas. A lot of the papers back up Glenn, and they have similar mindsets. Okay, so that's good. I also point out that Glenn said we typically want to look at their post-tax net present value, or at least the net present value. We also want to see the IRR. So we're seeing a lot of transparency in these numbers. It's great. (2023) is the first full year of production. He said if people assume $18 of silver, they have $11 of margin, right? So 18 essentially minus 7, right? Rounding up. Okay. So that margin is important for these miners, right? If silver went up to 50, 100, 1,000, 100,000, a million, a billion, that margin still, that at least that cost to mine, thus then calculating the margin is still important. Okay. Now, this is my favorite part of the video, and this is where I get to meme a little bit. He said, if people assume $40 per ounce of silver, he'll buy me a beer. So here we go. Chris Ritchie, I hope you're watching this. Fingers crossed. Two things. One, you're gonna owe me a beer. I think I have some gluten allergy shenanigans, so we'll drink some alcoholic seltzer at some point far in the future. Maybe some shots of tequila since you're working in Mexico. We'll do it on the Day of the Dead. Who knows, man? And the second request is Chris Ritchie, Chris Ritchie. I'm stupid today. I'm tired. I can't breathe. Chris Ritchie, if you're watching this, can you bring back that silver hairdo that we saw? That's the Wall Street silver mascot. That haircut is awesome. So YOLO. This guy, if this guy sees this, he's gonna hate me. If I not hilarious. $40 silver, baby, you can owe me a beer. So stupid. I mean, we're almost to 30. Excuse me. It's raining out. Allergies, Okay, allergic cat. But we're almost to $30 a silver. So it's like I'm not even assuming 40 at this point isn't even absurd. Like hell, like it's all right. It's all right. It's all right. The long term trend was like 16, so like 18 seemed pretty bad, hard to get. I mean, 20, people don't know how high it's gonna go. Excuse me. So yeah, I can see how 40 is ridiculous. I saw a graph the other day that in the 1300s, which yeah, the technology is definitely improved, but like silver was like $1,300 an ounce or something ridiculous. So we're definitely gonna see it go back up. So I will forgive Richie for, you know, thinking it would never hit 40. To the moon, baby. I mean, it's also remember JP Morgan's being short squeezed. So let's say silver had a fair market value, right? Of let's say it was 30. That Chris Ritchie doesn't have to buy me alcohol. At this point, I used to drink tequila straight, just no like what mixer, like anything to wash it down with at all. Just I would get. I'm not proud of this. I mean, I'm not proud of this, but I mean, I would just be slamming tequila, limes, and salt. So that's gonna be the the move when silver hits. We'll say 50, right? Because I think 50, that's gonna be a hard number to get. 40, I mean, that's gonna happen. I think personally. We'll see. Um, so when silver hits 50, we're gonna bring back tequila for Day of the Dead. Maybe before, if it hits it before, and then we'll. I have not drank in a while, so it's gonna be rough. But Day of the Dead. Will also, I'm probably be dying on Day of the Dead. Oh, good lord. Oh no. But yeah, so since JP Morgan's being short squeezed on silver, it's like the actual value of silver, let's say it was 50, right? So it's outside that 40 realm, because I think 40 is pretty reasonable. 50 will be harder to get. Since JP Morgan's being short squeezed, if silver's fair value was like 50, even that doesn't matter, because it's like JP Morgan's got to buy a bunch of it back. It's like silver could go to 10 million, 15 million, 20 million, a billion, maybe not a billion. I don't think they're that they have that much wealth or whatever, but the underlying value of silver at this point doesn't matter, right? So they cover their shorts, which will help in true price discovery. Which, if anything, in my previous video, the bull run of the 1970s was to go buy silver is going to increase by 1,000%. So if we assume, right, I'm not, this is a very rough number, right? But if we said what's 16 times 1,000%, I mean, even that's 160, and I think it's gonna go higher than that. I don't remember what Happy Hawaiian's predictions were based on his smoke indicator. I know I had asked him. I don't recall. Yeah, I don't want to throw out a number there and be misquoting him, but at the very least, we have a long high rise to go. This sucker's gonna owe me a bottle of Jose Cuervo. I'll buy him a bottle of Jose Cuervo if it goes to 160. I don't give a damn. At that point, I'll buy him. I'll buy him what they make this from cacti, right? So I'll buy him a cacti farm and make his own Jose Cuervo. Please bring back the Wall Street silver hairdo, my friend. Please, please. So what's nice about this is we can see they're doing exploration to they're doing they're doing drilling to explore the mine, right? Once I get sleep, I'm much better with English. But once they're I I could use some Jose Cuervo right now. Anyhow, they're doing their drilling focused on exploration, right? So they might not necessarily, I could be wrong on this, drilling out all of the silver, right? Just enough to make a profit, stay afloat, continue their exploration, right? Probably buy some other properties with some extra money, start exploring those, right? So they're exploring. They're not necessarily going for that full on give us all the silver in this and gold in this mine. And we can see in that May 19, they went ahead, they switched to that next phase of the infill drilling. So now they're really ramping up that silver production. Okay. And probably gold too, I would assume. 100 million of project level free cash flow and 10 million spent per mine. A lot more interesting with $40 silver, right? Yeah. Excuse me. So growth converting 40 million ounces uh, to being dealt with, processed, mined, what have you. Most of them aren't going to help in the first couple of years. So they're mining from cash flow, not dilution. That does not affect the net asset value or price. I think that's a very good mindset once again. I like that as an investor. Excuse me, I feel a little sick today. It's raining, there's mold. It's not fun. 130% higher than their average. That's good. They're expanding around the profitable veins. That's smart. Less than $1 million to access some extra resources. Nine, 10 million ounces at a high grade. Help the rest of the mine, right? Take out the lower grade tons. Higher production profile. Yeah, that's good. Better margins. Which better underlying business. I like that, right? Nothing wrong with that. So conversion to help expansion. 15 of the known 45 veins are in the current mine plan. And if they have a lot of cash flow, like you're saying, What does that help them do? Explore those veins versus having to sell the mine to someone else or like dilute shares or merge with someone. And then they're spending some of that extra money on more exploration. It's a great plan. Explore or convert what they currently have, expand the current mines, and then find more mines. Like that's how you win in this sector. Excuse me, a little sick. $2 million for El Pichacho. I hope I'm saying that right. 100 ownership of 11 mining concessions. That's good. I like 100% ownership. Some other miners have like 50-50. That can cause issues, I'm sure. Fifteen and 45 veins. El Muerto 2020 proves deeper mineralization exists. So still finding silver. Now it is more expensive to dig down there, sure, but silver prices go up. I mean, it's certainly economical. Can I kind of zoom through the rest of this because I think that was the gist of it. So hey, thanks to Peter Krauth. I hope I'm saying that right for this video. Thanks to Metal Investors Forum for hosting this sort of thing. Thanks to Chris Ritchie for really providing some insight into the business, the industry, the macroeconomics behind it, especially macroeconomics for people probably starting to learn to invest. I know a lot of younger people are really starting to look at investing in the stock market. I think this video is great to really develop an understanding of the macroeconomics of, I mean, overall, right, for any company, the mining sector, and in particular, this company. I also, he's got a good sense of humor. So I find, find that hilarious. Please bring back the silver Wall Street silver hair and Cinema model Jose Cuervo and silver it's 50. Um Now, and just to reiterate before I close out on this video, is to me, from my understanding thus far, I want to kind of converge some of what Glenn said in his article. We want to look at the discounted cash flow per the mine. I know that Chris Ritchie was kind enough to essentially provide that in, I mean, not the monetary terms, but at least the silver. Where are you? Right there. Oh, a lot of the data that Glenn wants to see companies release is captured in this slide. So that's great. That's +1 for transparency. Excuse me. Well, that felt better. Allergies. Anyhow, so that's good that we have different sources saying what is good for the mining industry and these companies to show, and we're getting that right. So back to this, I think the most important metric for me looking at these miners is this sort of thing. So median trailing 12-month free cash flow to enterprise value. Now I will be playing around with some other metrics, but this seems to relate to what Glenn was saying as well as Chris Ritchie. And I do want to maybe make a video soon about some of the other research that Crestcat Capital has put out there, because some of that also is very good for macroeconomic investing, which I encourage viewers to learn more about macroeconomics as well as microeconomics, because I think that can help make more informed financial decisions on a personal level, what you're buying at the grocery store, or in terms, in this case, of investing. So hopefully this video has been enjoyable. Um, I'm not sure whether the YouTube video sound went through, so I'm sorry if it didn't. I'll have to figure out something about that in the near future. I didn't really think about that prior to starting, and I like to do one take. Sorry for kind of wheezing and coughing. It's rainy season starting, and the mold aggravates my allergies, plus I didn't sleep so well. Hopefully you found this video insightful regardless. Hopefully you learned some stuff about silver, the economy, the Federal Reserve, investing, maybe making economic decisions for yourself. Why I like this stock in particular. Hopefully this video does some good in a lot of different ways for you, just in terms of learning. I like this stonk. I'm fully invested in this stonk. So there it is. Once again, I have an econ degree from UF. However, I'm not a financial advisor. I'm not making any recommendations of a stock. I'm just covering a stock I like, and a precious metal that I think it works hand in hand with, I guess, silver and gold. So maybe two, more silver than gold. And I encourage people to do their own research outside of these videos that I'm publishing. I don't do this for money. I don't want money from this outside of my investments, obviously, or outside what I make from the company running a good business investment. Right? I guess I should clarify. I just do this for educational purposes. Hopefully it fills that need. So yeah, this is not a legal endorsement of any sort of a particular stock or company for me to make money off of people watching this video. So SEC, please don't kill me because I haven't done anything wrong. What a day. This is Wobbly Giraffe signing off. I hope it's been a good one. Have a good, today's what, Friday? Yeah, today's Friday. Have a good weekend. See you around. Bye-bye. How do I, oh, there we go. I gotta stop the share. See y'all later. Stay cool. Enjoy the outdoors, please.